Hi, this is Daniel with Structure Strategies. I'm a real estate financial consultant. I help people increase their cash flow in their lives and do that for individuals and businesses. Today, we're going to be talking about Velocity Banking. Velocity Banking is a portfolio management system. These are strategies, techniques, and tactics that are going to allow us to increase our cash flow, accelerate debt pay down, manage risk, and improve credit. This is not a refinancing system. This is not a budget. So we're going to look at the problem. And the problem starts at the banks. So we're going to go and we're going to look to get a loan from a bank. And what they're going to do is they're going to ask for our credit reports, our financial statements, and everything else to generate a risk profile for us. Using that risk profile, they'll take an interest rate and they'll take our income and they'll generate a monthly payment and an overall amount that we can pay off using that amount. So this is the maximum amount that they believe we could possibly pay back. Okay, this is the very maximum amount. And looking a little bit closer, financial advisors recommend spending less than about 30% of our income on housing, but 43%, the amount that they're going to lend to, is about 50% of our overall income. This is 20% higher than the financial advisors are recommending. But, we're human and we're told that we can get $300,000, so we take $300,000. And this is going to put a large strain on our budget. So we're going to look at the truth in lending on this loan that we just got. And for the example, we're going to use a mortgage with a payment for $200,000. At 4.2%, that payment's going to be $976. So the first payment of principal is about $300, and the first payment interest is about $700, or 71% of the payment. The total interest after 30 years, if we pay it off, we'll have paid $151,000. That's approximately 75% interest on this loan. It's a lot higher than the 4.2% that's advertised. And honestly, this is what we're paying. We're paying 75%. If we look at that 4.2, we can take that and make it a monthly rate. It's going to look lower. Of course, we can make it look lower, but the reality is after 30 years, we'll have paid 75% in interest. At the end of the first year, the balance is $196,000 about, and we've paid $3,500 in principal. To pay that $3,500 in principal, it cost us $8,315 in interest. Comparable rate for that year is 244%. After 50 payments, we fast forward a little bit. This is 4 years and 2 months in. The balance is now about $185,000. We have paid about $15,000 in principal, and it's going to cost us $33,000 in interest to do that. That's a 44% APR. And really, this is what's going on. 4 years, paying $33,000 in interest to pay down $15,000. It's costing us $33,000 to pay off $15,000. So now we kind of understand how much this money is costing us, both in the short and long term. So let's look at some common suggestions that a lot of people will say. And the first one is to make additional payments. And this could be a good strategy, but the challenge is, where do we get this money from? We still have other expenses in our life and we maxed out our budget. We don't want to divest from our 401k or savings contributions or anything else. We want to make sure we keep those vehicles going, because that's what's going to pay for our life and our livelihood. So, where do we get this money from? The second strategy is getting a shorter amortization schedule. A lot of people will suggest this. And what's going on here is you're going to pay more principal, but you're going to pay the same amount of interest in relation to that. And what's basically going on here is you're forced into additional principal payments. If you made that same payment on a 30-year loan, you would pay it off in that shorter amortization schedule. The only difference is, you have the flexibility and the option to do that with the shorter amortization schedule. And finally, you hear a lot of people say, refinance for lower payments. This is broadcast on news stations. This is everywhere. Everybody's saying refinance to get a lower monthly payment. Now is the time. It'll never be better than now. And they're going to say that again in 3 months. But the challenge here is this is restarting the whole process. I mean, this is actually a real problem. You're going to pay another $32,000 for just $15,000 in interest. And you're going to repeat this every 5 years if you're an average American. It's a serious problem. So no, I absolutely do not recommend refinancing in 95% of situations. So now that we know that those suggestions aren't very good, let's take a look at the solution. And this is a solution. I think it's a pretty good solution. Let me know what you think. There's another bank product. It's called the line of credit. And features of this line of credit, it's typically got a higher interest rate than loans. I mean, you're going to see 10, 12, even 16, 20%. But this interest is calculated on simple interest based on the average daily balance for a month. And we're able to affect this interest a little bit. We can put our money in by making a payment. We can take money out by making a withdrawal or purchase. And while our money's in there before we make the purchase, it's going to affect that interest rate. So thinking about this, what would happen if we put all of our monthly income into the line of credit and we only take it out to pay for expenses? It's going to lower our average daily balance, right? But really, though, this is equivalent to putting that same money in an account paying us monthly interest. I mean, how much interest are you getting in your checking account, your savings account, your money market, your CD? I mean, you're not going to get nearly as good an interest rate as you're paying on your lines of credit or other revolving lines of credit, right? When you get 0.5%, I saw 1.4% average on a billboard just yesterday. 1.4%. Big giant letters, like that was the greatest thing since sliced bread. 1.4%. And then those same people that go and get that CD are paying 8% or 12% in their consumer debt. Really, and what's going on here? So now that we kind of understand one thing that we can do, let's look at a scenario. We have that same mortgage as before, $200,000 at 4.2%. We have a line of credit with $25,000 limit and a 16% APR. Let's take that line of credit and we're going to make a payment to the mortgage using this line of credit for $15,000. The monthly interest payment is going to be $200. How long would it take us to reach $33,000 in interest? It's just 14 years, but we pay that same $33,000 in interest in only 4 years. And this is before we even start treating this line of credit like our checking account. So it's going to look like this. We have the daily interest cost and the daily balance on either side. And what I want you to notice is that those charts look exactly the same. I mean, there's just a different color, really. And then the numbers on the axis, the y-axis, are a little bit different too, right? I mean, we're paying $15,000. It's going to cost us $6.60 a day. We're paying $13,000. It's going to cost us about $5.60 a day, right? So we can see that by putting our money in there, we're going to pay a lot less per day. Right? I mean, if all our money is sitting in there, we save about $1 a day. That's a decent amount. So let's talk about some frequently asked questions. First question you get, do you still have access to your money? Is this safe? And the answer is yes. And this is a yes, but. Yes, but you need to follow the proper protocol. There's things you need to do to make sure that you're still going to have access to that money. But additionally, this is important to note. You're still going to have access to your money while you're doing this. So we're able to actually put more into this than we would have making the additional payments that was earlier discussed. And that flexibility, once again, is incredibly important. Does this create more debt? No, this isn't going to create any more debt. You're going to still have the same overall debt that you owe. This is just going to transform it into a different product. And finally, is this risky? And yes, if you don't do this correctly, or if you don't have discipline, you're going to create more debt doing this. And this is actually really important to note. If you don't have the discipline to handle a day-to-day budget, this is probably something you shouldn't do. This requires actual discipline. This requires you not to spend every penny. If you look at a credit card and you think free money, this is not for you. However, when done properly, this method will actually reduce the amount of risk that you have in your life. And that's because you're decreasing your risk profile by lowering the amount of debt you have, but then you're also maintaining access to the funds. You're making your life more liquid and less debt. So that's incredibly important. All right, let's put it all together. Let's put a little sample scenario. So we got a Houston budget, got a mortgage of $200,000, 30 years left. We have 2 cars, total debt's $29,000 with about 3 years left. And we have $6,000 in consumer debt. Our total debt is $233,000. This is what that would look like paid off. So the maroon line here, we've got, it's the traditional line. You're going to pay that off in 30 years. It's going to take $156,000 of interest to do that. And in the first month, our cash flow recovered is none because we're not changing anything. Then today we talked about basic velocity banking. This is the basic method, all right? And doing that is going to save us about $100,000 in interest, $98,000 and a couple $100 in interest. We're going to pay that off in 10 years and 2 months. And we're not going to change our cash flow really in the first month because this strategy doesn't really include that. Now, we didn't have time to talk about the advanced method today, but the advanced method, you're going to pay about $48,000 in interest, saving about almost $10,000 from basic. You're going to pay it off in 8 years and 2 months, so we cut off about another year and a half. And in the first month, you'll have an additional $330 that you can apply towards your life if you need to. And finally, we have advanced method 2. And this method, you'll be able to pay $39,000. You're going to pay it off in 7 years and 3 months. And within the first month, you're going to instantly have $1,000. Now, This is all good and this is great. We're able to save hundreds of thousands of dollars doing this because this is, a snapshot today, but you're going to have a lot of other life events going on. And doing that, this method is really, really powerful. But the true power is that now we are able to actually look at the amount we're making. We're able to look at investments a little bit more analytically. If we know how much we could make by putting it in our line of credit, how much could we make into another investment? And if we take the rate of return that we expect to get with this investment and we subtract our velocity banking investment, now we look at the real rate of return that we're getting on the new investment. And if we're not comfortable with that return with the risk that comes along with it, then it's not a good idea to invest. But if we are, now we have money freed up that we're able to use. And especially if that money creates cash flow, this is a really powerful thing that you can do to expand your wealth. Not only are you reducing your risk profile, not only are you paying down debt incredibly fast, but now we're actually able to go out and generate wealth. And that would be advanced method number 3, if that were to be a method. Thank you very much for your time. You guys have a wonderful day.